This is Financial Standard, the definitive source of news, thought leadership and analysis for Australian wealth management professionals. Financial Standard. Take the lead.
Welcome to the Financial Standard podcast. I'm your host, Karen Vergara, a senior journalist at Financial Standard. As we come to the end of the year, many investors are doing the usual crystal ball gazing, trying to get an idea of and prepare for what the coming year might have in store for us. The reality is we're still feeling the effects of the COVID-19 pandemic, which in addition to geopolitical turmoil around the world, has really driven inflation. These, coupled with other factors like the rise of AI, have really challenged traditional thinking around portfolio construction, and it's almost guaranteed that this will continue to be the case in 2025. To discuss this and more, today I am joined by Nick White, who is Mercer's Global Strategic Research Director, and also a lead author on Mercer's new report called Themes and Opportunities for 2025. This report provides a snapshot of the swing dynamics that are shaping the investment landscape for the year ahead. Nick, thank you so much for joining us.
Thank you. Glad to be here.
Nick, as mentioned, Mercer has recently released its report, 2025 Themes and Opportunities. Can you tell us about the latest report and what the main themes are?
Okay, so let me start by introducing what Themes and Opportunities is about. It is our flagship document from within our team. It's really focused on what we refer to as the structural trends and emerging risks with a time frame of 5 years and beyond that are shaping markets and economies and that have clear implications for investors and advisors in the work that they do. So we categorize those structural trends and risks into 3 areas. The first of which is regime change, the second is super cycles, and the third is megatrends. And if you think what those titles imply, we're essentially we're increasing the time frame with each of these, and just a moment on each of those. So in terms of regime change, we're talking about one-off shifts in conditions from an old normal to a new normal. And really there may be some kind of shock to the system. There's some kind of impact that is basically causing that transition. And there may be some spike in conditions in the meantime that eventually eases and you come back down, but you don't end up in the same place. Now, often why that happens is because there are super cycles and megatrends in the background. So there's a connection between these. So super cycles, what we're talking about there is they are long-term sweeping cycles. They outlast market cycles, things like commodity cycles, debt cycles, political tension cycles, which are really, really topical at the moment. And then we move into megatrends, which are less about the cycle and more about the one directionality of it over time. So there's a certain sense of inevitability, never like using that word, obviously, about the future. But there's an element of it which gives you some senses. We believe that there's going to be genuine developments that will continue to develop over the years ahead, and whether that's related to things like climate change or natural capital or indeed AI. And maybe I'll just, if that's okay, I'll just touch on some of the themes in each of those categories.
Absolutely.
And then maybe that will provide some context for those. So in the context of regime change, there are 3 themes that we're looking at. The first perhaps is the most obvious, which we refer to as the highs and lows of benchmarks. And everyone is experiencing within the listed markets, the concentration in the US, the concentration in the megatech, lots of talk about US exceptionalism, lots of talk about tech boom 2.0. And we're very keen to express that actually Tech Boom 2.0 is very different from Tech Boom 1.0 in that this is not just about price multiples. There are some fundamentals in there and it's all about AI. And come on to talk about that a little bit later, perhaps. State of rates is really about that interest rate cycle as interest rates start to soften. It's happening at different speeds in different economies, lots of potential for dynamism in that area. And lots of opportunities, continue to be opportunities in the private debt market, despite a lot of money entering that space. Private markets de-siloing is a really interesting one. Not everyone has private markets, but a lot of investors do. And a lot of investors have a lot more of private markets than they used to have in prior years. So there's a need to be a little bit more holistic in your approach of private markets there. And understanding that there's a range of new investable opportunities for investors to get into, but also that the lines are blurred between different asset classes. So, for instance, in digitalization, there's data center, real estate or is it infrastructure? Do we care? Probably not if you're investing holistically, but if you've got them into boxes, maybe you do. But also in areas such as energy transition, where renewable energy will sit within infrastructure, but the next wave of innovation may sit within private equity or in venture capital, for instance. So that's regime change, and that's really just one of the three areas. I'll touch on the others. So the next one is super cycles. So the first one is referred to as security of everything, and it's really worth digging into this one a little bit more, because when we talk about security of everything, as the name implies, we're talking about multiple factors there. Security of energy, security of resources, security of reserves, cyber security, security of food even. And these are all interacted, and there's a really interesting link between how you approach security and how you approach sustainability. They are no longer, they're certainly not separate issues anymore. Balancing the economy is the next one. Balancing the economy is really around wealth inequality and the implications that has. It's certainly connected to the political environment where there is distrust in institutions as a result of wealth inequality. It's the rise of populism. All of this we are seeing over the last few years. And of course, this is a big year for it. The last area, which is megatrends, and there are 4. We've talked about energy transition at length for many years. We will continue to talk about energy transition at length for years to come. But we specifically refer to these days Transition Today. It's a paper we put out earlier in the year, highly regarded paper. We talk about the 5 streams of transition, and we've looked to separate some of those within our megatrends area this year. So we talk about energy transition as one of them, but we also talk about the move towards adaptation. We talk about circular economy, we talk about natural capital, and we talk about fair transition. It's all 5 of those streams that really represent transition today as we look at it. Circular economy is its own theme. We see that as absolute huge going forward because it lends so much. I would like to talk a little bit about that today. And natural capital is a continuation of what we talked about last year about the biodiversity risks and the potential for investors to really be part of that food transition that's so desperately needed. And then the last one is a topic on everyone's lips, which is AI. And we refer to it as AI into everything because it is in everything. And the opportunities really are absolutely vast across multiple industries. And it's the approach you take to it it needs to reflect that going forward. So lots to talk about.
Absolutely. Very interesting indeed. Nick, as you said, the report is published annually. So is there anything in particular that is new in this year's report that you want to call out?
Absolutely, I would. So just to reiterate the way that it works, obviously we're talking about long-term trends, but the paper is very focused on areas that we think are really most relevant in the short-term environment. So as I mentioned, in terms of the way we look at transition, we're looking at it much more holistically across multiple areas. We're certainly seeing in the energy transition space, we're seeing a lot of progress in the energy transition space. So for instance, renewable powered electricity is expected to exceed that from coal globally in next year in 2025 for the first time. It's already happening in places like the EU, but not at the global level. So that's a big shift. But there's a massive transition ahead of us. Emissions are still rising. We're just hitting 1.5 degrees centigrade. So what that means is there's a big shift that needs to move to the next wave of transition, the next wave of innovation and adaptation, shifting from energy transition to adaptation. I think that's really important. But I think the biggest change this year, and it's a really interesting area, which is in that middle area in the super cycles. So we talk about the security of everything, as I mentioned, and we go into a little bit of detail about the different areas. So maybe just give some insight into those. So security of energy, there is no doubt that as a result of both COVID and indeed the massive conflict in Russia and Ukraine, the realignment of supply chains, that's been talked about at length. Now, in terms of the implications for energy security, of course, when we're in the panic zone, right in the early days, it was all about the security of fossil fuels. But very quickly, that focus shifted into the acceleration of renewable power programs. Now, why is that? Partly because there's an energy transition in the background. So if you're making that transition, well, accelerate that so you've got more power coming in from those sources. But also, and this is really fundamental, there are two new strands. So if you think of energy transition being three strands, the transition to renewable power being three strands. The first is energy transition. The second is the economics. And as we know, the economics of solar and wind have changed dramatically over the last 10 years. But the third is security. Very simply, if the sun shines and the wind blows, or if they don't, you have storage in the background. That is local power. That is homegrown power that is secure from a sort of protectionist point of view. Now, interesting in the context of that is that you need critical minerals in order to build that kind of capability locally. And production is certainly is heavily centered in China, which is not comfortable with everyone. So there's a natural protection. This is creeping in there, and things like the IRA and the CHIPS Act and so on, they were about bringing that production back home. Of course, with the resources, even if you can bring the production back home, which is a major transition in itself, obviously, you cannot physically pick up the resources out of the ground and move them to a different ground. So friendshoring is so important in that space. But what's interesting is that the protectionist policies around critical minerals have increased fivefold in the last few years. So that's an indication of just how people are seeing that as a really critical component. Just going across a couple of the other areas within security, we talk about security of reserves. So we've talked in the last few years about how the appeal of gold, and we've seen gold produce extraordinary numbers over the last few years. We've been talking about it for a few years, and even we have been quite positive on gold, have been quite surprised by just how strong it's been. And that's been really, it's because it's transitioned from being something that was around creeping inflation risks. And of course, this is going back a few years, and around monetary debasement risks. That's where gold started, but it very quickly evolved into a story of central banks looking to diversify their reserves away from US dollar assets. So gold being a very small market, central bank reserves being absolutely vast, you can imagine that's a bit of a bottleneck that's impacting gold prices. And we've certainly seen that come through in that area. Cybersecurity is huge. As the sophistication of cyber attacks and the frequency of cyber attacks increases all the time, then the sophistication of cyber protection obviously needs to keep up with it. And AI is both sides of that equation, quite frankly. So attacks become more sophisticated, so does the protection. And it's interesting, our Sentinel team who do cyber risk reviews have honestly never been so busy, as you can imagine. The last one then is security of food. And I have to say that probably worries me more than anything that we're looking at, which is why there's a topic in itself around natural capital, the natural reorder, as we refer to it. Food calorie production needs to increase by 50% by 2050 because of growing populations and growing middle class. At the same time as production of food needs to dramatically reduce its footprint. Deforestation, an area the size of Australia has been wiped out since, I think, 1950, or half the size of Australia since 1950. If we continue on the same way, we're going to meet the 50% increase in calories at the other side of Australia. That's the amount of acreage that's being lost. That, of course, has implications for biodiversity, and 69% of land species since 1970, I think it is, have been wiped out. So we are causing all sorts of problems on this planet. Now, managing problems is one thing. So you need to manage risk in this portfolio. We're seeing creeping regulation come through. But there's also lots of opportunities in the regenerative agriculture space. So that's maybe something to explore as well. So lots of new things, really.
Yeah, fascinating stuff indeed. Given the political backdrop currently, the ongoing geopolitical turmoil, record number of elections, Nick, how do you see these factors influencing investment strategies in the next few years? And more importantly, what should advisors be particularly aware of?
Absolutely. So I think the first one is volatility. So in an uncertain political environment, in a shifting political environment, in an area of protectionism, in a world that is no longer unipolar or is very, very clearly multipolar, even as the regime change that we're going through and we settle into this new normal, whatever that will be, it's happening at different speeds around the world. This means you have volatility. It means you have dispersion. It means you have lots of opportunities for dynamic strategies. So certainly in the bond space, we're seeing a lot of potential for dynamic bond strategies, whether they're in the listed space or indeed actually the opportunities in the private credit space, which continue in particular in asset-backed finance, which is a particularly interesting area for us. We'd certainly be recommending that investors and advisors go down that route. The next recommendation is going to sound a little bit boring, to be honest, because it is basically chapter 1 of Investing 101, which is diversification. In a world that is volatile, you simply don't know what is going to perform next. And in markets that have become increasingly concentrated, there is a risk that that concentration starts to unwind. Now, I want to be careful there because I don't want people thinking that we're saying it necessarily will unwind, because Tech Boom 2.0 is fundamentally different to Tech Boom 1.0. There's very strong fundamentals coming through from the megatech. There is genuine productivity growth margin seen in the US compared to other regions. So there are strong fundamentals behind what we're seeing. At the same time, concentration in markets tends to move in very long cycles. And when it tends to unwind, when it develops, it's not great for active management. When it unwinds, it tends to be very good for active management. And that's really important because active managers are naturally looking to diversify their portfolios. So as things concentrate, it tends to make it harder and harder for active managers to keep up. Well, if and when that concentration unwinds, that diversification will be absolutely critical. And it means that you should not overlook those parts of the portfolio that have been left behind. So value strategies, emerging markets. So for instance, I just mentioned critical minerals. Critical minerals are often found in value strategies. So if we see that as a thematic tailwind, well, that's an area where value could perform very well. So I'm probably highlighting there strategies that capitalize on volatility and strategies that protect against volatility. Well, there's one last one, which is strategies that cut through volatility.
Oh, interesting.
Which is really talking our area, quite frankly, which is thematic strategies. Thematic strategies can be very volatile in the short term. They're very subject to sentiment, very subject to hype. People get latched onto stories, should not get latched onto stories, should be looking for long-term diversified plays in these themes across multiple themes at the same time. But if you can play those, what you'll find is that they will smooth out over time and you emerge stronger because you're positioned to be the right side of history going forward. So all three of those angles, we would argue, are really important. And that's how you bring in managing those short-term volatile environment, but also balancing with those long-term trends that are coming in.
You touched on these earlier, but love to delve more into them. Over time, systemic issues such as climate change and biodiversity risks are becoming increasingly significant. So how are these issues affecting strategy, Nick, and what can advisors do about it?
Yeah, sure. So let's start with the energy transition, because I think that's one that everyone's very familiar with. I already mentioned that we're moving into this transition period where renewable power is going to be generating more electricity than coal. But there is the next wave of innovation needs to come through. So at a really simple and slightly baffling level, massive investment in renewable power has not been matched by a massive investment in grid and transition. And that seems a little odd because no point generating power if you can't get it to the users. So that's an obvious one. Storage is a huge, huge growth area. Of course, the rollout of solar and wind power, it needs to be matched by battery storage, not just battery storage, but other forms of storage, even things like gravity storage. So we're in Australia, people buying up old coal mines and creating gravity storage out of those mines. These fascinating ideas, a tiny, tiny proportion of the market. But, these are the kind of innovations that we need to see come through. And even areas within battery. So lithium ion, without doubt, is the dominant force within battery. But there's innovation in the area of sodium ion batteries. Now, it's very much a nascent stage. We're sort of talking at the research stage. But these are the kind of things that could be future investments for people to really be part of so that they can be, part of the next wave of the transition. And dare I say it, we need to move from mitigation into adaptation, which is a scary concept in itself. The energy transition has all been about, moving to clean up the energy source, clean up the emissions. And while we still need to deal with the hard to abate sectors, and by that we mean heavy industry, which is steel, aluminium, cement, and heavy transport, which is shipping, trucking, and flying, we still have to deal with those areas. That energy transition is accelerating. The problem is that emissions are still going up. And we, in 2024, look like we're hitting 1.5 degrees. Well, we are hitting 1.5 degrees. And that's really, really fundamental in the trajectory that everyone's talked about for climate change going forward, which means that investment has to shift, not to give up on mitigation. It has to continue to fuel mitigation, for want of a better pun, perhaps. But then it has to move into adaptation. Now, whether that is things like protection against flood risk, it's protection against hurricane risk, it's protection against heat damage, even things like cooling systems. People are going to need to work in cool environments going forward as the world outside heats up.
Absolutely.
Planting mangroves around coasts to ensure that we don't get soil and sand runoff, every time there's a flood. There's lots of things that really need to happen at a massive level. And in particular, it's really needed in developed economies. It's really important because the financing gap there is huge. There's a UN report that talks about financing gap of about $500 billion per annum.
Wow.
Per annum. These are big
That's
numbers.
US dollars, is it?
That's US dollars, yeah. So it's pretty huge. And that's just energy transition. We can talk about biodiversity risks. And I mentioned some of the statistics earlier on. So just to clarify, so it's 420 million hectares of forest since 1990, 69% species population decline since 1970. Just clarify those numbers. And what we've seen is really intensive farming, which is causing soil erosion, which is using excessive nitrates. And what we need is a massive transition there in the agriculture space, moving towards a mixture of deeply traditional processes and also highly technical processes. It's interesting. It's really quite polarized. So in terms of traditional processes, we're talking things like multi-cropping and planting trees around to stop erosion and so on, managing water risks on your property. These are actually really quite traditional things that we moved away from with intensive farming coming through. At the same time, you want to balance that with highly technical process, drones skimming over the top of your farms, measuring water usage, measuring fertilizer usage, measuring damage to crops, such that you can be really efficient with the use of those supplies, simply because we need to be more efficient about these things going forward. It's a fascinating area. And you talk to the experts in this space, they live and breathe this. There's some fascinating opportunities to be made in the agriculture space and the natural capital just generally. Looking further around sustainable forestry, as people move towards sustainable sources going forward, forestry, I think, continues to be something that will be attractive going forward. But then there's other more niche areas which are very small at the moment, could be bigger going forward, which is vertical farming, where it's controlled environment farming, essentially. So basically that's keeping all of the water within the unit, moving to the point where you need no fertilizer. It doesn't work for big farm output like cereal, but it works really well for things like salad and so on. We would expect this to become an area that will continue to grow and maybe even grow within cities, because it's the kind of thing that can happen in an underground car park, for instance. Now, maybe that's a bit ambitious and maybe that's not something that really happens at scale. But certainly if I was building a building, that's the kind of thing that I would be looking to do. And if there's time, I'll just touch on one more thing, which is the circular economy. This is a fascinating area for us. So the circular economy is based on 3 principles. So eliminating waste completely. 2, keeping materials in circulation at their highest value. And 3, regenerating nature, which I've already touched on. The circular economy was maybe born out of sustainability, but it's all about efficiency and it's about productivity gains. So the more that you can make use of waste, you can build, you've got efficient use of materials, you've got lower cost materials to use, but you can still end up creating products that are of exactly the same quality. So for instance, I maybe just pick on 2 examples. Both of these, by the way, are long-term partners of the Ellen MacArthur Foundation, And I had the pleasure of interviewing Dame Ellen MacArthur at the Dublin Global Investment Forum. She's an extraordinary woman, innovative, passionate, dedicated, extraordinarily successful, like global record-breaking sailor. And then she moved into the circular economy because she is fascinating. She sailed around the world. And of course, in doing so, in order to break records, she had to keep her resources to an absolute minimum. And yet one of the places she sailed to was South Georgia, where she experienced an entire ghost town, which is built around whaling. And of course, we know that the whaling industry died, and probably for the right reasons. But it just left this entire ghost town and all the materials there. And it sort of dawned on her that this waste of materials was what was the way of the world, and was absolutely not the way of the world. The two partners I refer to, the first one is the Renault Group. They have a remanufacturing capability housed in their refactory in a business called the Remakers. So, it's fascinating era. And the other one is actually Arup, another long-term partner. They worked with a Dutch architect to essentially rebuild the AMP building here in Sydney. It's called Quay Quarter Tower. You'll see it as you come in. I come in from Manly on the ferry every day, and I see this every day, and it makes me smile because when they built this, they retained 68% of the original building. They saved $130 million of building costs as a result. A year of building time and 12,000 tons of emissions.
Wow.
And it won World Building of the Year, and it's been dubbed the first upcycled skyscraper. And it's just my favorite example of the circular economy in practical application. And as I say, seeing it every day.
Wow, I didn't know that. That's really fascinating. I'm going to look at that building differently from now on.
Yeah, great.
That's awesome. Finally, Nick, what should financial advisors take away from this year's report? And what are your key messages?
Yeah, sure. So maybe it's just a recap on a lot of the things I've already covered, which is, so don't give up on diversification. So certainly in the AI space, which perhaps, we haven't spent too much time on, you really should be looking for the next wave of AI. AI is going to impact across multiple industries. Don't think that just the listed equity concentration in the megatech is really the future. Ensure that you're not forgetting those areas that have been left behind. Value, emerging markets, global real estate is another fantastic opportunity. We're seeing extraordinary value there with dispersion of returns, at literally 1,000 basis point level in that space, creating lots of potential to capitalize on return going forward. Ensure that you invest in those dynamic strategies to really capture and capitalize on the volatility out there. Look for opportunities in the fixed income space, such as asset-backed finance that I touched on. Look to incorporate themes into your strategies. And maybe the only one I haven't mentioned, which is really focused quite deeply on your currency strategy. Because in a world of volatility, where in this multipolar world, currency returns, often an overlooked source of return, positive or negative, they need to be managed going forward. So even if you end up saying, I'm happy to leave it flexible, I'll just take on the currency risk, be active about being passive. Just really understand what your currency impact in your returns going forward will be.
They're great points there, Nick. Thank you so much for joining us on the podcast today and sharing the work that you yourself and Mercer and the team have done. You've given us a lot to consider for the year ahead.
Thanks for having me.
Thanks for listening to this Financial Standard podcast. For more information, visit financialstandard.com.au. Please keep in mind that the information discussed in this podcast is general in nature and does not consider personal circumstances. Reliance should not be placed on any content without further independent financial research and advice.